Every day, thousands of new participants enter the Indian equity market, drawn by the speed of modern trading and the promise of consistent income. But there is a massive gap between the expectation of a quick win and the actual outcomes recorded on the exchange. India now hosts the world's largest volume of equity derivatives trading. Millions of individual accounts are active in the futures and options segment, yet for the vast majority, these instruments are not producing wealth. Regulatory data from the last 2 years reveals the scale of this disparity. This chart shows that 91% of individual F&O traders ended the year with a net loss, leaving only a tiny 9% who managed to remain profitable. In aggregate, the capital lost by the retail sector reached a staggering 1.05 to 1.06 lakh crore rupees. These figures weren't pulled from a single brokerage or a small sample. They represent the official findings of the Securities and Exchange Board of India. A 91% failure rate indicates that this isn't a matter of bad luck. It is the result of retail participants using sophisticated institutional risk transfer tools without understanding their underlying mathematical design. Most of this activity is centered at the National Stock Exchange, where the surge in retail participation has pushed volumes to record highs. The primary draw for the individual trader is leverage. These contracts allow someone to control a large position with only a small fraction of the total capital, creating the potential for significant returns on very small price moves. However, the foundational purpose of the F&O market is not speculation. These instruments were designed for institutions to transfer risk and buy insurance for multi-billion-dollar portfolios. To understand why retail capital is being incinerated at this rate, we have to deconstruct the mechanics of these contracts and see where the individual trader loses control. The market is a neutral mechanism. If a participant trades a risk management tool like a lottery ticket, the internal mathematics of the contract will steadily move the balance of their account toward zero. At its most basic level, a derivative is just a contract. It has no value of its own. Its price is entirely dependent on something else. Imagine a farmer and a baker agreeing today to trade wheat next month at a fixed price. As wheat prices change, the agreement's value fluctuates. If wheat spikes, the fixed price contract becomes highly valuable. In the stock market, we simply replace wheat with financial indices. This is a real-world anchor. Every Nifty or Reliance derivative contract is tied to the actual performance of these underlying assets. A future is a mandatory agreement where both parties must complete the trade. An option gives the buyer the right, but not the obligation to buy or sell. Buyers pay an upfront premium for this choice. If unused, the premium is lost. Distinguishing between a binding obligation and an expiring right is the first step in seeing why directional bets often fail. If these tools carry such high risk, why are they the standard for professional asset managers? For an institution, derivatives act as insurance. An airline buys oil futures to lock in fuel prices, protecting their business from sudden cost spikes that could lead to bankruptcy. A large fund uses F&O as a protective layer for stocks they own, offsetting losses if the market turns. Most retail traders do the opposite. They don't own the underlying asset, simply betting on price direction, while using leverage to inflate their position. This leverage, or margin, allows a trader to control a huge position with very little cash. It multiplies potential gains, but it multiplies the potential for a total loss just as quickly. When the market moves against the trade, the institution's derivative pays out like an insurance claim. But for the unhedged retail trader, the entire account is wiped out because they have no underlying assets. The professional survives a downturn because they used the contract to limit risk. The retail trader fails because they used it to maximize exposure. The instrument itself is neutral. The trap is formed when a trader combines an unhedged directional bet with aggressive leverage. There is a variable in options pricing that exists entirely independent of stock price. It is the primary reason why many traders lose money, even when they correctly guess which way the market is going. It is best visualized as a block of ice. From the moment the contract is created, it continuously loses value as time passes. This is known as theta, or time decay. It measures the rate at which an option's premium evaporates as it approaches its expiration date. Part of the price you pay for an option is extrinsic value, the cost of time. Every hour the stock doesn't move in your favor, the contract's value shrinks. You are paying for time and it is constantly disappearing. For an option buyer to profit, the stock has to move in their direction fast enough to overcome this constant melting. If the market moves slowly or stays flat, the time decay will eventually consume the entire premium. Unhedged buyers are fighting a war on two fronts. They must be right about the direction of the market, and they must be right before the clock runs out. These mechanics, leverage and time decay, are the primary reasons behind the SEBI data. A 91 paper trading is the only way to witness the impact of theta and leverage firsthand before your own capital is on the line. And controlling your position size is the only way to ensure that a single bad trade doesn't end your ability to stay in the market. Derivatives are powerful tools, but they must be treated like insurance, not a casino. To build a foundation for safe and disciplined investing, subscribe to Knowfin and focus on the lessons that protect your capital first.